All right, it's 4:05. I'm going to get started right now, okay? So like I mentioned, today's session is all about loans. I believe we have a few kids who weren't there in the last session because I saw a lot of names which were new. So I'm going to do a quick introduction to myself and who we are before I get started. For some reason, my screen, okay, there it is. Okay, so Anar's on the call. Anar's my partner, and she does the webinars for ages 5 to 10. And I'm Kavita. I do the webinars for 11 to 18. Anar, do you want to quickly introduce yourself?
Sure, yeah. For those who were on last time, you heard our introductions, but I'll just quickly reintroduce myself. So my name is Anar, and I help people invest in large commercial real estate deals, largely focused on apartment buildings. I run an investment firm from Greenwich, Connecticut. And before I started doing this, I worked at a large consulting company called McKinsey & Company. And I also have an MBA from Cornell University, and love doing this because not only is it something that I'm passionate about, but I have a little kid who is in that age group. She's 7 years old. So this is a nice way to connect my work with the education.
Thank you, Anar. So just a quick introduction to me. I did my master's in computer science from Texas A&M, and I was in technology for almost 20 years. During that time, in the last 10 years, I also started buying rental homes, and I became a landlord. And from there, I went into what Anar is doing, which is apartment investments. So we get in other investors and we buy apartment buildings. I'm also a life insurance agent, and I help people actually invest in life insurance and then take the money out and do investments with them. It's a concept called infinite banking. I'm also a realtor and help people buy houses. I actually closed on a house, my first house actually today in my house. The notary came to my house, which was interesting. Just some quick ground rules before we get started. Please ask the questions in the Q&A box. If you want to locate the Q&A box, now would be a good time. Some people have entered their names and who they are in the Q&A box, but generally the Q&A box, let's use the Q&A box for answering questions, asking questions, because it'll be an easy way for us to track the questions, because in the chat, what I found is a lot of people are typing stuff and we lose questions. So right now, can everybody find the Q&A box and make sure they have it open if they want to ask any questions? If you can't find it, let me know right now so I can help you. And the Q&A box is different from the chat box, okay? Can people say if they found it? Just somebody say yes. I know that means everybody hasn't found it, but okay, good. Thank you. All right. David Fleming raised his hand. Any question, David? Okay, if you found it, awesome. Okay, raising hands means you found it. I understood. All right, the other rule, ground rule is no chatting with other kids, no spamming, and the chat box should be used to ask legitimate questions. If you have a response for something, like let's say I ask a question and you want to respond to it, you can use the chat box and everybody can see it now. We will also today use something called Slido.com for a pop quiz today. So if you want to go right now to Slido.com and you can enter the code MLTS2, you should actually see a quiz pop up, but it won't pop up yet. It'll tell you to hold and it'll pop up when I'm ready to push the button on my side. Can everybody do that? Go to Slido.com and enter MLTS2. And if you have any issues, again, let me know in the chat box. Good. All right. I'm going to keep moving ahead. I know you guys are really fast because you guys are much faster in technology than we are. So I assume everybody got this. Unless you type otherwise, I'm going to keep moving ahead. So again, some of you were there last week, and I wanted to quickly cover this. Why this is necessary is because you learn a lot of things in school, but we want you to learn what it takes for you to be ready for the real world. And money skills are extremely important in the real world. So whether you're going to college, whether you're starting a business after college, whatever you're doing with your life, money is a very important part of our life. And learning how to use it, invest it, and grow it is just as important, because if you spend everything that you have, then you're never going to have enough money. Okay. Someone asked, what is the code again? The answer is MLTS2. I'm going to go back to that screen again if you need the code. It's Moneywise Learning Teens Seminar or series, whatever, MLTS. And the 2 is the session 2. All right. I'll keep moving. Like I mentioned, what you'll learn in this is all of these things. The ones in red are special. We're going to actually have, maybe move this credit one up for next week. We're going to have someone speaking. She's a credit specialist. She helps people build credit and actually restore credit for people who have messed up. So she's a credit diva. So she's going to come and talk about credit scores. This week, we're going to talk all about loans, and I'll also, in the red, highlighted college planning. We have a guest speaker for that, so that's definitely something that you should keep looking for. You should definitely attend, I mean. So a quick note, I just wanted to revise how many people, if you want to just raise your hands, how many people were able to get your assignment done from last week? That's awesome. I see a lot of hands going up. So let me see if I can get an idea of the number. So I'm going to launch a poll. So please use this poll. This is about your homework assignment and then also about your cash flow game. I wanted to find out if you guys got a chance to look at cash flow, and I want to understand how many people got that. And if you are new and this is your first time being here, don't worry too much about it. We'll catch up. That was a game that we played, or at least looked at, and I asked people to go home and play it. So it looks like about 30. I'm just seeing how many people attended. So about 35% of the people got a chance to do the assignment. 28% did not. About 39% said a little bit. A lot of people didn't get a chance to, so I hope that you get a chance this week to not only do your assignment, but also go back and play cash flow. All right. I didn't get a lot of votes. I don't know if some people are not seeing the poll, but anyway, that's okay. For those of you who didn't get a chance, or you did a little bit, do catch up on this week's assignment. Okay, the assignment is the best way for you to learn what this is about. I can tell you a lot of things, but when you do the assignment is when you really learn how your parents are doing it, and it's sort of more practical, right? Then this is more theoretical. It's like a lesson versus real life. All right, let's keep moving. So in your chat box, please tell me what were some of the lessons you learned doing the assignment or in the class, or whatever you want to share about what you learned. You can type it in the chat box. What's something you learned in the do not have a lot of liabilities? That's a very good point. You don't want to create a lot of liabilities. Paying loans is important. What are liabilities? Have assets to be rich. That is an excellent point. Every time if you ever want to make a lot of money in your life, just take away one lesson you want to take away from that entire last week's lesson. It's like you need to figure out how to create more assets in your life, which means it puts more money in your pocket and it pays for all the liabilities that you create. You get a good balance between spending and assets. There are good investments and bad investments, absolutely. Taking loans is not bad. This is amazing, guys. I am so excited that you guys know this. You learned what assets, liabilities, and income statements are. Passive assets are very useful to gain money through things like stocks. More assets means more richer people. There is good debt and bad debt. That's an excellent point. How you learned about assets and liabilities and how to make liabilities into assets. Excellent point. The difference between poor, middle class, and rich. Yes, assets do help you. That's perfect. That's awesome, guys. I'm really, really excited that you understood this lesson. And that's really, if there's one thing I want you to take away, is that when you grow up and you start creating, you start making money, remember about this lesson. If you remember one thing: whenever you buy something, ask yourself how many assets am I creating, or am I creating a lot of liability for myself? And if you follow that rule of creating more assets than liabilities, and also creating enough assets to cover your liabilities and then some, you'll be fine. Right. Income and expenses equals income statement. Perfect. Yes, Mihir. Okay, I'm very happy with that lesson and what you learned. So let's move on. So today I want to talk all about loans. So what is a loan? Does anybody want to say tell me what a loan is? When you borrow money from a bank, lending money to another person, borrowing money, absolutely. Here's the dictionary definition: a thing that is borrowed, especially a sum of money that is expected to be paid back with interest. So I could loan money without interest, but it's not in my best interest to do so, right? When I loan money to someone, whether I'm a bank, I'm an individual, I will expect to make money on my money. So loan is a sum of money that's expected to be paid back with interest. So every loan has three primary characteristics. One is it has a principal, which is the amount I borrow. It has a rate. It's interest I agree to pay. And I'm sure a lot of kids here have done this in math. I'm sure you've learned simple interest and compound interest. So can you raise your hand if you learned about simple and compound interest already? Awesome. Wow, I see a lot of kids. Okay, that's cool. So this won't be anything new to you, but there'll always be something new here. So you'll learn a lot of things here. Okay, awesome. Thank you. So there's three things: there's principal, rate, and time. Principal is the amount I borrow. Rate is the interest I agree to pay. Time is the time period I agree to pay the loan in. Normally, when you agree to take a loan, you'll have a payment schedule. The payment schedule is usually you have a certain amount of the principal you pay plus a certain amount of interest you pay every month over the loan period, which is the time period that you agree to pay in loan. For example, let's say you have a 30-year mortgage, then you agree to pay the lender a certain amount of principal plus interest every month for 30 years until the loan is finished. And every cent that you owe the lender is paid back with the interest rate that you agreed to pay back. Sometimes you not only have the monthly payments, but you also might have a lump sum due at the end of a period. So that's called a balloon payment. So let's say sometimes a lender will say, I have a 5-year loan period, but at the end of 5 years, you haven't, let's say, paid me the entire amount, then you'll have whatever is left, you'll have to pay it back at the end of 5 years. And that's kind of called a balloon because, like a balloon is big, you'll have this big payment at the end of that time period. Let's talk about what types of loans are out there. We have mortgages. A lot of kids are aware of this because Almost all of them have homes or their parents have bought homes. So this allows us to buy homes. This is tied to the house that is purchased. So what happens is the lender uses the house as the collateral, and collateral is basically like a guarantee for the lender to say, I'm loaning against this house. So they make sure that the house is worth enough that they can lend against. So for example, today we closed on a house. The house is, let's say, $300,000. The lender says, I'm going to only lend 80% of 300,000, right? He's not going to lend the entire amount. He wants you to lend or put down 20%, and that is called a down payment. Right? So if you pay 20% down payment, the lender covers 80%, and then together you have the cost of the house. So let's take a $300,000 house. 20% of 300,000 is $60,000. So that's your down payment. The lender gives 300,000 minus 60,000, which is 240,000 as a mortgage to you. And every month you go in and pay a principal plus interest on the mortgage. We have student loans. They are federal and private loans. Federal loans usually have lower interest rate than private loans. Do you guys want to guess what other kinds of loans there are? Okay, I saw some responses there. There are school loans, car loans. What else? What other loans are there? Medical loans, yeah, that you could take. I mean, you could spend on medical, and then that would be a loan that you owe someone. Although I don't know if anybody allows you to go borrow for medical insurance. I don't know that insurance is a loan per se, because you're not paying the insurance money. You're not borrowing from the insurance company. What you're saying is that if I get hurt, let's say I have medical insurance. If I'm sick, I'm going to the doctor, then you guys are going to pay. That's not a loan. You don't owe money back to them. So a loan is when you borrow money and return back all of the money with interest. So insurance is technically not a loan. We have car loans or auto loans. We have home equity loans. Does anyone know what a home equity loan is? Someone wants to take a stab at it? What's equity in a house? Anyone? So it is how much it's worth. It's dependent on how much it's worth. But let's say, I'll give you an example. I bought a house for $100,000. My house, I paid 20% down and I paid $20,000. The lender paid $80,000. Then my house appreciated in value because the market appreciated, right? Austin has grown, lots of cities have grown. Now my 100,000 house, let's say, became 150,000. Now I created equity in the house because now I've created that $50,000 extra in the house. That's something I can borrow against. Yeah? Does that make sense? So home equity is basically removing money from the house that has appreciated. Let's see, what are the loans? Small business loans. I'm a small business owner. Right now, with all the COVID crisis happening, there are lots of small businesses and they need money. They take a loan from the government or from banks to fund their businesses and to make sure that they can pay for their businesses and their employees right now. And even before COVID happened, there are a lot of entrepreneurs and business owners that take money for starting their businesses. So these are called small business loans. Okay, someone asked I should go slow because they're taking notes, so I will go slow. There are personal loans. The personal loans are typically the highest interest rate loans because they cover any purpose. So let's say I have a lot of credit card bills and I'm paying 20% interest for my credit card. But my bank says, hey, I'll loan you money at 6%. And it's a personal guarantee loan, like they're just giving it to you because your credit is good. Then you can use that to pay off your credit card, and that would be a personal loan. You can use it for any purpose. So let's say you have a lot of medical bills and you want to pay it off, maybe you'll take a personal loan. So there's a lot of reasons to take a personal loan. So let's talk about some other types of loans. It's not exactly a type, but there are two primary types of loans in terms of how the loans are structured. One is called an open-ended loan, or it's also called a revolving credit loan. So what happens in a revolving credit loan is that you don't take it all at once. You take it when you need it. So there's a lot of questions coming up, and I'm going to answer it when I take a little pause break. I don't want to interrupt the flow of the conversation right now, but I will come to it. Thank you for asking, and keep asking those questions as you get it, okay? And I'll come back to the questions when I get through these slides. So open-ended loan, you have a revolving credit loan is when you have a kind of line of credit. So for example, let's say I go get a credit card and the lender tells me, the bank tells me I have a credit line of $10,000. This doesn't mean I go get $10,000 from the credit card, right? I might spend only $1,000 a month on the credit card and pay it back. But you have the option to take it as much as you need it up to $10,000. So it's essentially a line of credit that's offered to you, and you can use it when you need it. You don't want to use it unless you need it, because then you'll be paying interest. So let's say I go to my credit card, I take a cash advance for $10,000 and put it in my bank and make 1% on it and pay the credit card company 20%. Does that make sense? It doesn't, right? So you want to use the money when you need it, and you want to swipe the credit card when you need it. So that's kind of how much. So you might only use like $1,000 after the $10,000 credit. It doesn't mean you want to use it all, right? And similarly, there's something called home equity line of credit. I talked about a home equity loan. So a home equity loan is when let's say your house appreciates in value, or you owned your house for 20 years and you almost paid off the mortgage. You have a lot of money in the house for what the house is worth. Then you'll take a home equity line of credit or home equity loan. And I will review home equity later. We don't need to go into that much detail. There's a lot of questions around equity, so I will talk about it. So the closed-ended loans, on the other hand, you don't take as you need it. You just take the whole amount at once. So let's say I talked about the $100,000 house. Now, if my mortgage is for $80,000 and I put a $20,000 down payment, then the $80,000 is taken all at once, right? You're not going to take $10,000 and then another $10,000. No, when you close on the house, the $80,000 has to be sent to the person selling you the house, period. And you have to give that $20,000 down at that time. So that's typically a fixed amount loan that is distributed for a specific period of time. So most mortgages are either 15 years or 30 years, typically for most houses. The interest rates are also typically fixed for these closed-ended loans. Although there are variable rate mortgages, we won't talk about them today, but typically we'll do a fixed rate mortgage, which means, let's say the lender says, I'm going to charge you 4% for 30 years, or I'm going to charge you 3% for 15 years. So it's fixed for the entire 15 years. So examples of these closed-ended loans are like a mortgage. So let's say you go buy a car for $20,000. You're not going to tell the dealer that I'm going to pay you only $5,000 today, and then I'm going to send you $5,000 after 10 days or 2 months or whatever, right? You just have to pay them $20,000 and get a loan for it for $20,000. So that's an example of a closed-ended loan. So I will answer some questions now, because there are a lot of questions around this and I don't want to move too far ahead. How do we create more assets than liabilities? This is the last week's question about assets and liabilities. We essentially don't go buy things which are liabilities. For example, you don't want to, let's say you graduate from college and let's say you have $20,000 in a bank. Right? You can go buy a car, but you just created a liability. Or you can go buy an asset. Let's say you buy a rental house, and that rental house generates more money or generates money every month, then you created an asset. Let's say you bought a car, now you had a car loan, but you decided that you'll Uber in the evenings and make some money. When we talked about this last week, I don't know if you were there, but let's say you make $1,000 a month and pay $200 in car payments. Now you created $800 of cash flow. So it becomes an asset. So that's how you create more assets. Is the down payment used to prove yourself accountable? Yes and no. So the down payment is basically the lender's way of saying, if I'm going to loan you $80,000, I want you to have skin in the game. I want you to put something down because tomorrow you can just walk away because you have no money in the house. Does that make sense? Okay. The other question is, can you review home equity later? I wish I had an example here. Let me see if I can do this. I've never done this before, but there is a way for me, which might be too much right now, but there is a way for me to draw here. So I want to see if I can draw this. Let me try. Okay, this might be too complex. I'm trying to find a drawing board to show home equity, but let me give another example of home equity. I bought a house for 100,000. I had a lender come in and loan me 80% of the house, which is $80,000, and I put a down payment of $20,000. Now I was holding the house for, let's say, the last 3 years. The house went up in value because the market was doing well and all the houses became more expensive. Now let's say my $100,000 house is 200,000. I essentially now created an equity of 100 plus thousand fresh equity. In addition to the 20,000 that I had paid down, my total equity is now 120,000. Does everybody understand this? Raise your hand if you do. Okay. Most people seem to understand it. Okay. Everybody understands the concept of down payment and home equity. Those are things I want you to understand. Can anybody with enough money give loans? They will give you a loan when you're worthy of taking a loan, which means they are a credit, basically they're looking at something called a credit score, which says how good is this person in terms of paying back this money. And we will talk all about credit scores next week. But for now, just understand it's your ability to repay a loan. Your credit score is a measure of your ability to repay a loan. So if your credit score is high, it tells the lender this person is very responsible. They've been responsible about paying their money and their loans back. So I can loan them money, no problems. If your credit score is low, they are basically saying that this person is not responsible and I don't want to loan them much money because they don't pay on time, or they don't pay at all, which is called a default. Is an open-ended loan free? An open-ended loan is not free, but you're charged on the loan only when you run the loan. So for example, let's say I take a 10,000, I have a credit card and someone gives me a $10,000 limit on the credit card. If I don't use the credit card, I'm not paying for it, right? Credit cards, usually you can get a lot of free credit cards. There are some credit cards you'll pay an annual fee, but you don't want those, right? They're usually free. So you're not paying for the loan until you charge the credit card and run up a balance month to month. If you pay it month to month, there's no fee. But if you let the balance stay on the credit card, then you'll have to pay interest on the credit card, which is very high. So an open-ended loan is free only if you don't charge the loan. If you charge the loan, then you'll have to pay for it. Can you get a loan if you don't have a credit card? Yes, you can. What's a line of credit? It's basically saying, okay, a line of credit is a way for you to borrow money, simply put. Okay? It's a way for you to borrow money, whether it's a credit card, whether it's a home equity line of credit, or it's a personal line of credit. There are different ways for you to borrow money from the bank. It's basically saying you have $10,000 or whatever your line of credit amount is available for you whenever you need it. You don't have to take it today, but you can take it whenever you want. Will there be an email link so we can view the slides again? Yes, I can share the slides. So it is caused by inflation. What is caused by inflation, Anirudh? I'm not sure of your question. Please ask it again. Why would someone with a high score, because then the lender gains money. Everybody would take a loan if they need it because sometimes money is cheap. So let's say I can borrow money at 4%, but I can invest money at 10%. Why would I lock my money up because I have more money? I wouldn't want to lock it up. I want to use my money where I can get the most money from my money. So if I can get a 10% interest on my money, I'll do that and I won't lock it up. I won't pay my house down with all cash because house loans are so cheap. I'm going to use cheap money. Say you bought a $100,000 house, 20K down. After 5 years, the remaining loan balance is only 60K, but the house is appreciated to 150K. Do you now own 60% of the house, even though you only paid 40% of the original price of the house? Absolutely, Rushil. You're bang on. You're right on the money. That's exactly what it is. So everybody, you should see what Rushil wrote here. This is exactly, he got the point. Your equity will increase as you pay down the house. I'm trying to send this to everybody, but I'm not able to paste it. Sorry, give me a second here. See if I can do this. I want to cut and paste what Rushil wrote here. I don't know if everyone can see Rushil's response. Oh, thank you, Rushil. So essentially what Rushil is saying is 100% true. Even though you only paid off, let's say 20 more thousand, your house appreciated 1 to 150K. Now you've created that 40,000, 20 that you paid down, 20 that you paid off after 5 years or whatever, and then 50,000 that you got in the house. That's basically how you made money. Okay. Are cash flow loans realistic? I don't know what cash flow loans are. Please re-ask. Anirudh says home equity. Home equity, is it caused by inflation? It could be. It's just that it's caused by appreciation more than it is by inflation, really. Inflation means the value of your money goes down. So it could be partly inflation because inflation means prices go up. But it's also appreciation, which means the market is generally going up. How old do you have to be to start securing loans? Generally, you have to be 18. I don't think people will loan under 18 unless you have a guarantor. How do banks make money? I know that interest on home equity loans, but sometimes people pay back. Banks make money a lot of ways. They loan. Of course, loans are a big way that banks make money, interest rate on the loans. But the way they look at it is not, sometimes there's defaults where people don't pay back, but a lot of people do pay back. So it all works out in the end because banks are usually making money. Let's say this crisis is happening right now, there might be a lot of defaults for banks. And that's something sometimes the government has to step in and bail out the banks because they lose a lot of money when that happens. Is there a limit to how many loans you can have? This is a very good question. Not really. It's just limited by how your credit is. There are people with tons of mortgages. Like I have 11 mortgages. So it just depends on how much you want to get and how much you're capable of paying off, right? Why does appreciation occur? Appreciation occurs because of one, inflation. It's normal market forces where everybody is paying more. Things become worth more because inflation is definitely one of the reasons. Anar, do you want to talk about that? Why does appreciation occur?
What's the question again? Sorry.
Why does appreciation occur in the market besides inflation?
Oh, besides inflation, demand supply, right? I mean, let's say in an area, suddenly, I live in a suburban area, which is right outside New York City. And if there is a new railroad line that connects this direct into New York City in under 30, suddenly there's a lot more demand to live in the neighborhood, the schools better, and so on and so forth. So now that the demand is higher, price goes up, and so you'll have appreciation in home value.
Supply demand issue. Yeah. Uh, does a property gain value after time? It can, it cannot, depends. So let's say you bought a property last month or this month, maybe it won't gain value in the next year or two because the market's not doing so well. But maybe after that, things will come back on. But let's say you went and bought it in Sleepy Time Village, and Sleepy Time Village doesn't have any demand, like nobody wants to live in Sleepy Time Village, then your value can go down. Again, what Anar talked to, the supply and demand is a very important part of value. So you want to make sure that when you buy property, you buy it in a good location. Would it make sense to buy a house using a loan, even if you have money to buy it without the loan? Awesome question. I like it. To me, when it's cheap to get money, let's say the interest rate is right now 3.5%. To me, it's historically one of the cheapest times to get a loan for a house. I'm talking about a house. So I wouldn't want to lock up my money into a house because now I can't get it out easily. I have to go get a home equity loan. It costs me much more to get a home equity loan than to just get a loan to start with. So yes, it would make more sense to get a money to buy a house using a loan, because now I can use that money to maybe buy 4 houses and put it on rent instead of buying one house. So I see a lot of people, they think it's great to pay off their house loan. I don't agree with that philosophy, because let's say you go buy a house for $200,000, but now you could actually use that 200,000 to buy 10 houses and rent them out and make cash flow. Now you're creating your assets, you're creating more assets with the same amount of money. So why wouldn't you get a loan? But the time you wouldn't get a loan is when loan is expensive. So let's say instead of 3%, I charge you 10% for a loan. Then maybe it doesn't make sense for you to get a loan, right? You'll have to weigh that factor. Will a personal loan help a credit score? Loan doesn't really help a credit score. Paying off the loan on time will help you improve your credit score, because what a lender wants to see, and we'll talk about this a lot next week about credit scores, what the lender wants to see is that you have been responsible in your loan payments or your mortgage payments or any kind of things you take on. So sometimes taking a loan under your social security number is a good thing, because if you can show, take a loan and pay it off every month on time, that on-time payment is recorded by a credit bureau and it improves your credit score. What is inflation? Again, not a topic for today. We'll get to it some other time. Do we define price by how many people want it? It's kind of true, because the more people want it, the more demand there is, and the more demand there is, the less supply there is. And when there's less supply, the prices go up. Okay, I think I answered all the questions here. If you had any questions that I didn't answer, please ask it again. I'm trying to clear up all the questions here. If I missed your question, please ask again, okay? I'm just going through the questions again, just to make sure. If you don't pay your loan on time, what happens? Does the interest rate become higher? If it's a fixed interest loan, the interest rate doesn't necessarily become higher, but you will have a late payment. Let's say there are 3 options. One, you don't pay the loan at all, in which case the lender can come and take whatever collateral. So in case of a house, it's called a foreclosure. So if you don't pay your mortgage on time, the lender can come after you and say, you know what, I'm taking the house back because you haven't paid me your mortgage. So they don't bother increasing the interest rate. They just come after the collateral. But say it is a credit card, right? They could bump up your interest rate. They could rack up more and more interest on your credit card, because they don't have a collateral there to come after. A collateral is basically what you use the loan as a guarantee. And that also hurts your credit. So you never want to do that. You always want to make sure you pay on time. Is there a limit on the number of loans you can have? Not really. I think I already answered this question. What can you use loans for besides property? You can use it for cars, you can use it for student loans, you can use it for any personal purpose, anywhere you need money. You don't want to use a loan and do nothing with it, because then you're paying for something that you don't want. Like, people use loans for furniture. Personally, I don't want to take a loan on furniture unless it's a 0% loan. What is the credit score? We are going to talk about it next week. Hang in there. Are loans in a game cash flow realistic? It's realistic in the sense of it just gives you an idea of how loans work. So yes, you can take loans in cash flow. What happens when someone does not pay interest and the credit card company adds interest, but the person cannot pay it? So there are a couple of things. If people don't pay over a long period of time, then the credit card company can come after you and sue you and basically get your assets. So let's say I have a house, they can come after you. And then you might have, if you don't have anything, you might declare bankruptcy. So it just depends on what you have and what you don't, but they can come after you if you don't pay it, besides screwing up your credit completely. If you do forget your loans, do they keep the money you used to buy their house? If you do forget your loans, do they keep the money you used to buy their house? I'm not sure I understand the question. I don't know if it's Sahil or Ria asked that. If you forget to pay the loan, all the money, let's say you put 20% down, you lose the money that you put 20% down on, okay? So you actually lose money when you get foreclosed. Correct. This is a very good point that Abhinav brought up. There is a limit on the loan you can get. It's called debt to income ratio. That is a very good point. I didn't want to make it too complicated, but the amount of loan you get depends on how much money you have and how much previous debt you have as well. But what is interesting is that when you go buy a rental house and the rental house can pay for itself, it doesn't affect your debt to income ratio very much because the property is self-sufficient. It can pay for itself. This is why it's not always true. Like, there are people I know who have 25 mortgages. Now, if you count debt to income on all those mortgages, they probably won't qualify by themselves. But because these houses are rented and they're cash flowing, they do qualify. So it's very complex there. So I didn't want to just say debt to income ratio there. Okay, I think I'm moving on ahead. How many people understood the concept of down payment? Please raise your hands. Awesome. Lots of them. Okay. How many people understood the concept of equity, home equity, or equity in anything? Home equity. Please raise your hand. Equity is simply the amount of money you build in the house. Pari said she couldn't understand it. It's the amount of money you have in your house. Okay. And I'm going to keep moving on ahead because there's not much time. So the other thing one has to understand is some loans can come with what's called prepayment penalty, which is simply, very simply, let's say I borrow 100,000. And then next day I decide, oh, you know what? I have 100,000 in my bank. I don't need this loan. I'm going to pay it off. The lender wants to make some money from you because that's why he's lending. And suddenly you've taken away the opportunity for him to make money. So some loans can come with what's called a prepayment penalty, which basically says you've taken away my opportunity to make this much money out of you. So I'm going to charge you a prepayment penalty for it, which means you prepaid the loan or paid the loan too early, paid it off too early. Interest on loans can be simple or compounded. I already spoke about that, and we'll talk a lot about simple and compound interest loans today. And I didn't realize it's already 15 minutes, so I have a lot more stuff to do. So after what affects interest rate, we're going to take a little break. I probably will run over. If you have a problem staying, then please drop off. You'll see the recording later, so don't worry about it. So let's talk about what affects interest rates. There are a lot of factors affecting interest rates, and I'll talk about some of them. One is the Federal Reserve. The Federal Reserve, also known as a Fed, impacts what's called the short-term interest rate, or called the Fed funds rate. The Federal Reserve is a government kind of entity which raises or lowers the interest rate. And a lot of kids might have heard recently that they almost dropped the rates to zero here, right? Almost zero. So a lot of these short-term loans, like a very short-term loans, like we have adjustable rate mortgages, which means the mortgage rates keep changing. Those kinds of loans, they follow what's called the Fed fund rates. The second thing is called the long-term interest rates. It's affected by the treasury investors. So who are the treasury investors? Let's look at treasury notes. Okay, very simple concept, but don't overcomplicate it for yourself. The treasury is basically a loan you make to the government, to the US federal government. You can think of it that way. Like, let's say I go buy a $100 treasury note, then basically I'm lending $100 to the US government, and the US government guarantees certain amount of interest on that $100 loan that I make to it. So you can buy a lot of notes, and essentially by buying the note, you're giving a loan to the government. The interest rates on 30-year and 15-year mortgages and all these other longer term loans, like 5, 10, 15, 30-year notes, they follow the yields on what's called the 10-year treasury note. So the 10-year treasury means that you made a loan to the government for 10 years, right? It's 10 years loan. And it's called a treasury note. And the treasury note gets sold in the market just like anything else. And people offer a certain amount for the treasury note. So when the demand for the treasury note is high, that means you get less interest. So let's say I have a lot of people who want the treasury note, then the interest rate on the treasury note drops. When there is very low demand for the treasury note, then the interest rate goes high. Just understand, if you get anything out of this, understand that your mortgage interest rate and long-term interest rates are affected by the 10-year treasury. That's all you need to understand from here. So this is just a picture of a graph of how the treasury and the federal fund rates go. The federal fund rates determine the short-term interest rate, like short-term loans, and the 10-year treasury determines the long-term interest rates in the market. So you can see here, right now, they're kind of both up there together, almost at below close to 1%, right? Very low right now. They probably dropped some more, and this graph doesn't even show how much they've dropped. So they've varied over a period of time, but they've kind of almost at the same thing here. So this is this one is the short-term interest rate, and this is the long-term loan interest rate. So besides the actual market rates, there are other factors which affect the interest rate. So banks decide how they want to loan money, right? There's something called a prime rate that is decided by the bank, and this is above the federal funds rate. So basically, the bank borrows money from the Fed and it loans money to you, and they decide to take a little more money in the bargain, right? Because the banks have to make money as well. So this is the interest rate, let's say for credit cards can be 10%, 12%. It can be ridiculous. So the banks are making that money because the Fed is loaning them rate at, let's say, 1.5%, and then they charge you 10% on the same money. So they're obviously making money there. There's personal loans, there's small business loans. All of those are controlled by banks themselves and not by the Fed fund rates or the treasury notes. So there are three people who basically affect your interest rates in terms of external forces. It's the Federal Reserve, it's the treasury note or the treasury investors, and the banks. So what factors affect your loan? There's a lot of factors, right? Now, the type of loan, for example, a mortgage is lower interest than maybe a personal loan. Right? A car loan is even lower interest than a mortgage loan. Like you can get a car loan for 1% right now. You can get a mortgage for maybe 3.5%. Your personal loan might be 6, 7, 8%. So it depends on the type of loan. It depends on your credit score, which means how worthy of you are you of getting credit. So it can be excellent, it can be good, it can be poor, it can be whatever that range is. So the credit score is usually a number between 400 to 800. And you'll learn again next week about credit scores. The market rates are what I spoke about, the federal fund rates, the treasury notes, and the prime rate that the banks are charging. All of them are basically the market rate depending on the type of loan. Then you have the type of lender. So some private lenders might charge more, credit unions might charge less, a bank might charge more. So there are different kinds of people who loan money, right? The loan term. So let's say I get a 15-year mortgage. That'll come at a lower interest rate because basically the lender is loaning you for a shorter amount of time versus a 30-year loan, it'll be a higher interest. So the term of the loan or the time period of the loan affects the loan interest rate, the loan amount. So they say if you borrow under 100,000 for a mortgage, you generally pay a higher interest rate because it's too small a mortgage. But if your mortgage is like 300,000, then they might give you a lower interest rate because now they're making more money off of you. So I know I said a lot there, so I'm going to take a pause and look at all the questions which have come in. Are there questions here? Do you guys have any questions? Okay. All right, let's see. There are questions here. Are there car equity loans? No, equities in a car never goes up. It always goes down. Usually not, because the car is called a depreciating asset. It keeps reducing in value. All right. Do the interest rates stay consistent for long-term interest? No, they don't, because the treasury note interest rates keep going up and down. You saw the graph. So the interest rates for the long-term loans follow the 10-year treasury. So they keep going up and down. Is there a limit on how many treasury notes you can buy? No, it's just limited by how much money you have. What one reason would need to make a treasury note? I'm not sure I understand that question. I'm sorry. Are there car equity loans? No, there aren't, because usually you lose equity in a car. You could refinance the car. If your car is worth more, it usually isn't, because car will always be worth less than you bought it. The minute you drive a new car off a parking lot of a dealership, you lose money. How do you keep up with interest rates on loans to know when to get one? You can go to bankrate.com. You'll always, there's so many websites out there. The bankrate.com is the one I use. They show all the interest rates on different kinds of loans. Can you repeat what I said? I don't know what I said when I said, what about antique cars? That's a point. Antique cars can have value for sure. Yeah. I mean, if you can fix up an antique car and resell them, and let's say an antique car is fixed up and you sell it, someone can get a loan on it, yes. But I've never heard of a car equity loan. You can probably finance a car and get some money out. The class usually ends at 5. I'm going to be over. So if you want to stay in, you can stay in. If you need to drop off, I'll have a recording. You can catch up later. What is Federal Reserve? The Federal Reserve is a government body that regulates the monetary or controls the monetary policy or the money policy of the country. Okay? It's the monetary arm of the government. Monetary is basically money. Sorry, I'm talking about Central Time. It's Central Time, 5 o'clock right now. The class is supposed to be over. So, but I will keep going on. If you guys cannot stay, I drop off. If you can stay, please stay. I will do the first pop quiz right now. So please go to Slido. I see a lot of people on Slido already. If you're not on slido.com, please go to slido.com. Okay, I'm going to start Urjit, please type your question. Hey, you guys, you want to stop right here and continue next week or the week after on these loans? If you want to stop after this quiz, we can stop and we can continue. How many people want to stop? Raise your hand after the quiz. Okay. I got enough stops. So I'm going to stop after this quiz. Let's answer this quiz and we can break, okay? I'm going to cover the loans, like compound interest and simple interest loans in the next class. Or the class after, because we might do a credit score the next class and we'll do the interest loans the class after next, okay? All right, let's go do the pop quiz. Please come to slido.com. Is everybody there? Who's not on slido.com, please raise your hand. I will send the recording out to the email address registered. Who is not on slido.com? Can you raise your hand? Tina, you need to go to Slido, slido.com and use, yes, Liam, go to Slido, slido.com and enter the code MLTS2. I'll give you a few minutes and I'm going to kick this off now, okay? Who's not on Slido.com? Mindy, I know we want to start, but I need to make sure everybody's there. Thank you. All right, everybody on Slido, I'm going to start now, okay? Can you guys see the questions? Awesome. Cool. All right. So I'm going to move ahead. What type of loan is a credit card? Open-ended or revolving loan? That's the right answer. Who mainly affects the long-term loan interest rates? All right. Is everybody done answering? I'm still seeing the sliders moving around. So, all right, let's see the results, okay? It's the treasury investors that affect the long-term interest rate. Remember the 10-year treasury, the short-term interest rates are affected by the Federal Reserve. The borrowers actually don't play any role in affecting the interest rate except from their own, and that was a trick question, right? They don't affect the long-term interest rate. The treasury investors affect the interest rate, and the borrowers with their credit scores affect their personal interest rate, like what they get. What is a prepayment penalty? Wow, everybody got that one. Almost. Some people got a little confused. All right, we're going to go with these. The correct answer here is penalty paid when the entire loan is paid off too early, right? Because the lender wants to make money from you when you take a loan and you pay it off too early, then they're going to charge you a prepayment penalty. And this is not always, but whenever you take a loan, you want to make sure and ask, is there a prepayment penalty? And then you know that if you pay it off early, you'll have a penalty. What type of loan can be used to get money from a house when its value goes up? I talked about this a lot today. All right. I think almost everybody got it. Some people got a little confused there. It's a home equity loan. We talked about when the value appreciates, you get a home equity loan to take money out of the property. You can also do something called a refinance to take money out, but it costs you more to do that than to get a home equity loan. So you should always look at getting a home equity loan when the value goes up first. What factor does not affect, okay, read the word not, affect your interest rate on a loan? It's not affects, it does not affect. There's a negative there, right? See here. And the correct answer is age and race. It's got nothing to do with your age. It's got everything to do with your credit score, your loan term, your loan type, and the kind of lender you're using. Let's see here, who got all of those questions? So can you guys see the leaderboard? Can you all see the leaderboard? Raise your hand if you can see the leaderboard. No, okay. Let me share the leaderboard so you can see. I'll show you who actually got all of the answers right today. Can you guys see the leaderboard now? Raise your hand if you can see the leaderboard. Awesome. Okay, you can see it, the leaderboard. I'm sharing a screen. You should be able to see it. Okay, I'm just going to read it out. Havel, Urjit, Mindy, Abhinav, Hannah. I don't know who logged in as just A. It just says A. I don't know who that is. Malcolm G. All of you guys, 6, 7 of you guys got 5 out of 5. So these are people who got 5 out of 5. Awesome job, guys. All right. With that, I wanted to remind you guys to quickly do this. I'm just sharing my screen again. I have a quick assignment for you and then I'll let you go, okay? I know I'm running a little bit late, but please be patient. So next week we'll cover maybe credit scores, or we'll do, where is the assignment? I somehow can't find my assignment. Okay, there it is. Share my screen. Give me a second. Can you guys see the assignment screen? Somebody say yes. I just need one yes. Okay, awesome. I want you to talk to your parents and use their help to put together to understand what kind of loans they have. You can use online calculators. So the simplest one you can do is go to Google and type mortgage calculator, or go to Google and type car calculator. You'll actually see it pop up right in Google. So that's the simplest one, and I encourage you to use that because it's very simple. It doesn't take into account a lot of other factors, which I don't want you to confuse yourself with. Then discuss with your parents what kind of loans you might be basically taking when you go to college. What kind of interest rates are they charging for those kinds of loans? So let's say you might take a car loan, you might take a college loan. I want you to go to bankrate.com and figure out what kind of interest rates they're charging and understand what kind of loans are out there. So how much do you think something like this will cost you monthly? Like, let's say you take a college loan for $30,000 or $50,000, whatever you think you'll spend as a college loan. And then you have a car loan for, let's say, $20,000. How much do you think your monthly payment would be? I want you to work out a number for me and understand how much that cost is. Okay? And I'm going to share this with you offline. You don't have to worry about typing this assignment with you. I'm going to send an email with this. So it'll be coming to your inbox. Please check your emails and make sure you do the assignment again. This is how you learn. Okay. And we'll talk about complex compound interest and simple interest in another class. Yes, we are stopping.